If you were born before 1966, there's a good chance the bank account you've had for decades is set up in a way that guarantees it gets frozen the moment you die, not eventually, not after some long legal process starts. The freeze happens almost immediately, and it happens because of paperwork most account holders in this age group never updated, simply because it wasn't standard practice when they opened the account. If you have money sitting in a checking or savings account right now, what happens to that money the day you pass away depends entirely on 3 or 4 words, on a form you probably haven't looked at in years or ever. Stick with me, because by the end of this video, you'll know exactly what to check on your own accounts this week and exactly how to make sure your family isn't locked out of your money at the worst possible moment. Here's why this specifically affects people born before 1966. Payable on death and transfer on death designations, the forms that let money skip probate entirely and go straight to a named person, didn't become standard, easy teller-counter paperwork at most banks until decades later. If you opened your primary account in the 1970s, 80s, or even into the 90s, there's a real chance nobody ever offered you that form, and nobody's mentioned it since. Millions of accounts opened during that window are sitting there today as plain single-owner accounts with no beneficiary attached at all. And a plain single-owner account with no beneficiary is exactly the kind of account that freezes hard the moment the bank finds out its owner has died. Understand what actually happens because it's not what most people picture. The moment a bank receives notice of a death, usually through a death certificate, sometimes just from a family member calling, sometimes from a government database match, every account solely in that person's name locks immediately, not just withdrawals. Automatic bill payments stop processing, scheduled transfers get rejected, direct deposits bounce back, and even basic balance inquiries get denied to anyone who isn't a legally recognized representative of the estate. This isn't a bank being difficult or slow. It's the bank following the law exactly as written. The moment you die, that money legally stops being yours to distribute by phone call, by a family member's memory of what you wanted, or by anyone's good intentions. It becomes part of your estate, and an estate has to be legally administered with a court-recognized person in charge before a single dollar can move. That's the piece almost nobody accounts for in advance. People plan for who gets what. Very few people plan for how long it takes for anyone to actually get anything or what their family lives on in the meantime. If there's no joint owner and no beneficiary designation on file, that account is now frozen until it goes through probate, the court process that validates a will, formally appoints someone with legal authority to act, and only then allows funds to move. Depending on the state and how backed up the local court calendar is, that process routinely takes anywhere from a few months to well over a year. Nothing about that timeline is negotiable by asking nicely at a branch. Meanwhile, funeral costs still have to be paid, a mortgage or rent doesn't pause because someone died, utility bills keep arriving, and the money that would cover all of it is sitting in an account nobody can legally touch. Families end up covering these costs out of pocket, sometimes going into debt to do it, while the deceased's own money sits frozen the entire time. This doesn't happen to every account, and understanding why is the actual protection here. There are exactly 3 things that let money bypass that freeze, and if even one of them is properly in place, your family gets access almost immediately instead of waiting on a court. The first is joint ownership with rights of survivorship. If a spouse or family member is a co-owner on the account, not just an authorized user, but a legal joint owner, ownership passes to them automatically the moment you die. No probate, no waiting. The account doesn't even technically freeze for them because legally it was always partly theirs. The second is a payable-on-death designation, sometimes called POD, or its investment account equivalent, transfer on death, TOD. This is a form, usually 1 page, that names a specific person or people to receive the account's contents immediately upon your death, without probate. Critically, the named person has 0 access and 0 rights while you're alive. You keep full control. The designation only activates on death, and then it activates fast, often within days once a death certificate is presented. The third is a living trust, where the account itself is titled in the name of the trust rather than in your personal name. Whoever you named as successor trustee can step in and manage or distribute those funds according to the trust's terms without ever touching probate court. If none of those 3 things apply to an account, it's exposed, no matter how much money is in it or how carefully you've otherwise planned your estate. And here's the part that catches so many people in this exact age group. They assume a will handles this. It doesn't. A will has to go through probate to take legal effect. A will tells the court what you wanted. It doesn't hand money directly to anyone the way a POD designation or joint ownership does. People who did the work of writing a will decades ago often believe that's the whole job. It solves some things, but it does nothing to prevent this specific freeze. So here's what to actually do this week. Call or visit every bank and credit union where you hold an account solely in your own name and ask directly whether there's a payable-on-death or transfer-on-death designation on file. Most of the time this takes 10 minutes and there's no fee at all. If there isn't one, ask for the form on the spot and name a beneficiary right there. You lose nothing by doing this. You keep complete control of the account while you're alive, and the designation simply sits dormant until it's needed. If you're married and one spouse's name is the only one on the primary account, consider whether joint ownership makes more sense for your situation than a POD designation, since the surviving spouse may need faster and broader access than a beneficiary-only setup allows, particularly for a joint household's shared bills. Every family situation is different here, and it's worth a short conversation with the bank about which structure actually fits your needs, rather than assuming one option is automatically better than the other. If you're an adult child helping a parent who was born well before 1966, this is one of the most useful conversations you can have this month, and it doesn't require bringing up a will or anything that can feel heavy. Framing it as simply making sure the bank has current paperwork on file is usually enough, and most banks will let the account holder update this in a single visit. One more thing worth checking while you're at it. Make sure the beneficiary designation actually matches your current wishes. Old POD forms sometimes still list an ex-spouse, or don't reflect a family situation that's changed since the form was filled out years ago. A designation that exists but is outdated can cause its own set of problems, so this is worth a quick review even for accounts that already have one on file. The bottom line is this. Whether your money reaches the people who need it within days or gets locked away in probate for the better part of a year, comes down almost entirely to whether a specific piece of paperwork exists at your bank right now. It costs nothing to check, it takes very little time, and for anyone who opened their main account before this kind of designation was standard practice, there's a real chance it was simply never done. This week is the week to find out.